Welcome to this explainer on navigating the highly complex and honestly, sometimes confusing world of retirement accounts. Okay, let's dive into this. When it comes to building long-term wealth, the actual accounts you choose to hold your investments in, well, they can be just as absolutely crucial as the investments themselves. Today, we're going to look really closely at the IRA, the individual retirement account, and we're putting the two major heavyweights head-to-head, the Roth and the traditional IRA. Section 1, the million-dollar tax trap. So why do we need to pay such close attention to these rules? It really boils down to one single word: taxes. We are literally talking about thousands of dollars at stake here. Making the wrong choice between a Roth and a traditional IRA could cost you thousands in totally unnecessary taxes over the course of your lifetime. Both of these accounts offer incredible wealth-building benefits, but if you fall into the trap of choosing the wrong one for your specific personal life situation, you're essentially just leaving a massive portion of your hard-earned money right on the table for the IRS. Section 2, Roth versus traditional basics. To make sure you completely avoid that tax trap, we need to really understand the fundamental choice you're making here. First up is the Roth IRA. The easiest way to think about a Roth is that you are being taxed on the seed. You take money that you've already paid income tax on, your after-tax money, and you plant it into this account. Because you've already paid the taxman up front, all of the growth, all the dividends, and all the withdrawals you make in retirement are completely 100% tax-free. You pay taxes on that tiny seed today, so the massive tree and all of its fruit are totally yours to keep tomorrow. Right, so on the flip side, we have the traditional IRA. If the Roth is taxed on the seed, the traditional IRA is taxed on the harvest. With this account, your contributions might actually be tax-deductible right now, which lowers your tax bill for this current year. The money then grows tax-deferred. But here's the catch. When you hit retirement and actually start withdrawing those funds, picking the fruit, so to speak, every single dollar you pull out is going to be taxed as regular income. Now, what's really interesting about this slide is when you contrast these two strategies side by side, you'll notice the underlying investment options, your stocks, bonds, mutual funds, they are generally exactly the same. The only real difference is the exact timing of that tax burden. Do you want to pay taxes right now, or do you want to pay them way later? It's basically just a giant timing game. Section 3, navigating the fine print. Okay, moving beyond just the basic timing of taxes, the IRS has some very distinct rules governing how and exactly when you can use these accounts. First off, there are contribution limits. This is a strict maximum amount you're allowed to put in each year. Now, the IRS updates these limits annually to adjust for inflation, so definitely always verify the latest numbers, but generally speaking, there's a hard cap. Then we have RMDs, or required minimum distributions. Guys, this is a massive difference between the two. Traditional IRAs literally force you to start withdrawing money and paying taxes on it once you hit a certain age. The IRS wants their tax revenue eventually, right? Roth IRAs, however, no RMDs whatsoever during your lifetime. You can just leave the money in there to grow forever if you want. Finally, early withdrawal penalties. Generally speaking, if you tap into the earnings of either account before age 59 and a half, the IRS is going to hit you with a pretty painful early withdrawal penalty. These accounts are designed specifically for retirement, and the IRS enforces that with steep fines. Now, these mechanics also build into some pretty complex eligibility rules. It's not a free-for-all. Not everyone can use these accounts in the exact same way. For the Roth IRA, there are strict income limits. If your income is just too high, you simply aren't allowed to contribute directly to a Roth, period. For the traditional IRA, anyone with earned income can contribute, sure, but the deductibility rules actually change based on your income and your employer. If you or your spouse have access to a retirement plan at work, like a standard 401k, the IRS might phase out your ability to actually take that tax deduction on your traditional IRA contributions if you're making too much money. Section 4, which IRA fits you? All right, we've covered the theory, but how do these rules actually apply to real people? Let's take a look at 3 specific investor personas to help you identify what might fit your own life. Our first persona is an early career investor. They're 25, just starting out, and they fully anticipate that their earning potential is going to grow significantly as they gain more experience in their field. For this young professional, the Roth IRA is often the absolute clear winner. Why? Because they are currently sitting in a very low tax bracket. It makes perfect mathematical sense to just go ahead and pay the taxes right now when their rates are at the lowest they will likely ever be. By doing this, they're locking in decades of compounding growth that will be entirely tax-free when they're older and presumably sitting in a much higher tax bracket. Moving right along to our second persona, this is a mid-career professional. They're 40 years old, making really great money, sitting in their peak earning years. But because of that, they are feeling the very heavy, very real burden of high current income taxes.
So the crucial point is, for this high-income earner, a traditional IRA often really shines. Taking that immediate tax deduction provides profound immediate relief right when their tax bracket is at its highest point. The calculation here is that when they finally retire and stop working, their income is going to drop, right? That pushes them into a lower tax bracket. So they completely avoid paying high taxes today and instead pay much lower taxes on the harvest later in retirement.
And that brings us to our third persona, a couple nearing the very end of their careers. They are actively planning the transition from the accumulation phase of their life into the withdrawal phase, and they fully expect their tax rate to drop shortly once the paychecks stop. Because they anticipate those lower future taxes, the traditional route still favors them. However, here is a absolutely brilliant pro tip as you approach retirement. Split your contributions. Having money sitting in both a traditional and a Roth IRA provides incredible tax flexibility. During retirement, you can draw from the traditional account right up to the top of your current low tax bracket. Then, let's say you need more cash for a vacation or a surprise medical bill. You can just pull from the Roth account entirely tax-free without accidentally bumping yourself up into a higher tax bracket. It's a game changer. Section 5. Costly mistakes to avoid. Listen, no matter which path you ultimately choose, you absolutely have to steer clear of these major potholes. Let's rapid fire through them to keep your wealth safe, okay? First, missing contribution deadlines. You generally have until tax day of the following year, so do not miss it. Second, ignoring those income limits and getting slapped with penalties for contributing to a Roth when you shouldn't have. Third, withdrawing funds early. Remember that strict age 59.5 rule? Fourth, forgetting those required minimum distributions on your traditional IRAs. I'm telling you, the IRS fines for that are ridiculously steep. And finally, assuming one account is universally better forever. Your life changes, your income changes, and your strategy definitely should too. To summarize our entire deep dive today, the ultimate truth is that the best choice is highly personalized. It depends entirely on a calculation of your current income, your best educated guess on your future tax brackets, your personal retirement goals, and your overall financial strategy. Because tax laws and your personal income constantly change, you really need to review these choices annually. And of course, you should always consult a qualified tax or financial professional to apply these rules directly to your specific, unique situation. We've looked at the rules, we've looked at the stakes, and we've explored the personas. So the final thing to ask yourself as you look at your own lifetime wealth strategy is this: are you better off paying taxes on the seed today or on the harvest tomorrow? Which path actually aligns with your financial future? Keep learning, review your strategy, and make your money work for you.